Joining us with potential opportunities in the sell-off is Neuberger Berman multi-asset CIO Erik Knutzen and Mariner Wealth Advisors Chief Investment Strategist Jeff Krumpelman. Guys, happy Friday. Erik, multi-asset, which is great. I mean, we've had some big price swings both in fixed income and in equities. Where's the bigger opportunity now?
Oh, on the margin, we would say we want to be leaning into short intermediate duration fixed income. We think there's an opportunity for some further curve steepening in here. And while we're generally at target in equities, we don't want to add to equity overall exposure at this juncture. We think that there could be more downside volatility, in part because in our view, a lot of the pricing of Fed cuts and any relief that could come from the first series of Fed cuts may already be incorporated into the market. We also expect a fair amount of volatility around geopolitical and election events over the coming months. And the next couple of months are pretty tough from a technical standpoint. So we want to hold tight here and look for opportunities after further volatility, probably a couple months out.
And Jeff, you're not convinced that there's a big further move down from here?
No, that's right. You know, there's a little deja vu, I think, John, about this time last year. You and I did a segment, and, you know, we had a year where we were up 26% for the year after a rocket ship ride in the first 7 months. And then we had a little moment in the third quarter where we pulled back about 11%, peak to trough, and yet the fundamental valuation and technical backdrop stayed still constructive. And the fabric of that's a little different this year, but I think this is maybe a similar moment to what we had last year. We didn't take our targets down. We kept our positive targets, you know, for the year. And, you know, this year we're looking for 6,000 by, you know, mid next year. But it could be a little choppy in here. Part of our back to normal thesis this year of normal earnings growth, normal rates of inflation, normal interest rates levels is normal corrective activity. So I wouldn't be surprised when you get hints of maybe a slowdown, people overreact. And I'd say relax. And there's no reason to be premature and think that we're headed for recession based upon the mosaic that we see. So
okay.
Hover your normal allocations is what I'd say.
Okay. So Erik, the other thing that's sort of hanging in the backdrop here for the markets, especially as we do go into a weekend, is geopolitics. You have tensions in the Middle East continuing to ratchet higher. You know, you've got the headlines that Washington is now preparing for Iran to attack Israel potentially in the coming days. How much is that factoring in, especially when, and I realize crude was lower today because of the growth fears, but in general, you're starting to see some asset classes perk up here and respond to this.
Yeah, so in general, we want to have our risk dials in our portfolio to kind of medium to low, hanging around targets, but not taking a lot of risk on the margin. One way to help hedge against some of the real concerns out there is having some exposure to assets that will do well if we do get further political or geopolitical shocks in the Middle East. So we do have on the margin exposure to WTI energy futures in order to benefit in that environment, and also gold as a hedge against potential further conflict, which we could see over the weekend or at any time. The last element is really around the upcoming election, where both candidates would likely continue to engage in deficit spending. That may not be fully priced in terms of its impact on longer-term bonds. But also, if you do get a Trump administration, we don't think the potentially inflationary aspects of his proposed policies have been recognized in markets. And there, again, having exposure to commodities and other inflation-sensitive assets could be a good portfolio hedge.